Hello and welcome to the latest edition of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to expect in the weeks ahead. Now, it's been 2 weeks since we last did this show and there's been a lot that's gone on. So we've seen the trade war escalate. At the point we did the last show, we were waiting to see if the trade war would escalate and what China would do. So there have been retaliatory measures by China. One of the biggest things that's driven markets is the idea that the Chinese may be starting to sell their holding of US treasuries. And of course, Trump has been ramping up his rhetoric. He also had an attack on Mexico in terms of claiming he was going to imply tariffs to imports from Mexico if they didn't try and stop the amount of immigration that was coming across the Mexican-US border. So it's been ratcheted up a notch. And so where we were last time, if you remember, I was talking about on the S&P 500, we would look at the 50-day moving average. That was key. Would we break below that? And then would we move below 2,800? And then would we go lower to 2,790? And that was the sort of 200-day moving average. Now, what happened as the trade war rhetoric escalated and both sides antagonized one another, we saw a sell-off in US equities and equities globally. What had started at the beginning of May continued right towards the end of May, and we saw markets fall down, and the S&P 500 in particular crashed through those lower levels, setting up quite a bearish picture. Now, since then, what we've been looking at is, could the market find a bottom? And we started to push through 2,800 and we got all the way down to 2,700. And the market seemed to find some support and then rebound. So it leads me to ponder, how was your May? So for anyone who follows 80/20 Investor and my 50k portfolio, which is a portfolio I run live on 80/20 Investor, so I tell you what I'm buying, what I'm selling at the time that I do it. Now, my portfolio actually made money in May, which, given that markets had collapsed, then that was, well, pretty impressive, to be honest. There were 400 funds in the two managed sectors that cover the 40 to 85% shares and equities, so funds that have between 40 and 85% in stocks and the rest perhaps in bonds, and the other sector, which is a little bit lower risk, that can have somewhere between around 20 to 60% in equities. Now, my portfolio outperformed both of those sectors, not just the averages, we're talking about all 400 funds in there. Now, obviously I'm pleased about that, but why I mention it is because you might want to check out 80/20 Investor and a free trial. But more importantly, it's about the power of a process. So the markets really popped in April, they jumped higher. But what we're seeing is a kind of replay almost of the beginnings of what occurred in December. So bond yields are selling off. And it doesn't mean the markets are necessarily going to collapse from here, but we're seeing lots of negative headlines. We're seeing bond yields collapse around the world. We're seeing the yield curve invert once again, almost globally, wherever you picked. Now, if you look at the stock market, get your stock market app out. So on your Apple phone, go and have a look. You can look at the S&P 500 and see that nice sort of rally into September time, then dip down into December, and then it sort of bounced again leading into this year. And we've now sort of hit a double top. It looks like a double top. It hasn't been completely confirmed, but where the market has hit that resistance level we had near all-time highs, it's now pulled back. And is it going to keep going lower? Now, the bond market, on the other hand, if you look at the TNX, if you type in TNX on your app, you'll see the 10-year US Treasury yield. Now, if you look at that going back over that same period, say 6 months, or further back into September, you will see there's a steady decline in the Treasury yield. There have been moments where it's actually sort of rallied a bit, but go back to September when we were up over 3% on the US Treasury 10-year yield, and everyone was telling you it was going to go to 4%. We are now down towards 2.12 at the time that I make this video. Bond yields have been collapsing. So what that says is there's fear in the market, or that the market is pricing in a recession. Now, what's been interesting in the last couple of weeks, we've seen lots of indicators alongside the US trade war escalation to suggest that we are heading towards a recession, most probably, and even some economists are saying that we are already in one. And don't forget, when you see GDP numbers that are published officially, they're always backward looking, so you don't actually find out that you were in a recession until many months later. So the question now is, are we going to get a sustained pullback, or are we going to bounce back to new highs? Now, what we saw in the last couple of days is the S&P 500 rebound, and that was largely because we had the US Federal Reserve start making noises that if we get a recession, then they won't be afraid to cut interest rates. So there's a lot of hope out there, and there's a lot of hope around the ECB today that there might be some sort of dovish moves by them. And the early indications are that after that meeting, they weren't as dovish as people had hoped. So there's a lot of hope in this rally that we've had in the last couple of days. We took the market on the S&P 500 back above 2,800, which is obviously a key support level. It'll be interesting to see what happens when the market approaches that 50-day moving average, because are we going to get a retest and another failure? So are we going to get a pattern of almost a zigzag down? We don't know yet, but there's a lot of negative headlines out there at the moment, a lot of negative sentiment, collapsing bond yields, collapsing economic data. So it's not a great picture, but that's not to say that we won't have a lot of buyers come into the market and buy the dip. So we've got to wait to see what happens in the next couple of days and weeks, and particularly it matters what Donald Trump says on the trade war front. And again, as I make this video, he's already making more noises potentially of ramping up tariffs, which the market hasn't liked. So we're in a bit of a limbo now, and we could be just moving sideways for a period, but we've had a pullback. So there is definitely some negative sentiment brewing out there, which has caught a lot of people by surprise, which is why my portfolio outperformed so many people in the month of May. Now, it wasn't just US Treasury yields that have been falling, meaning that bonds have been rallying. They've had an amazing rally and particularly a very good May. Now, there could be a bit of a pullback on those, but what it means is that anything like gilts, UK gilts have been very good. They performed really well, particularly my portfolio during the month of May. And they don't have quite the currency exposure, obviously, that you get when you have global bond funds. And what we've also seen in the equity space is anything that's almost sort of got a quasi-bond feel to it rally as well. So that means utilities, they've done well, and that means REITs, so sort of property equities, have done well in the last month or so, and particularly in this rally. Doesn't mean they haven't lost money, but they've definitely outperformed the rest of the market. So in the coming days, look out for any noises made by the Fed, other central banks around the world, also what's going to happen in the trade war with Donald Trump, but particularly what China are doing, because China are starting to show signs of retaliating and almost withdrawing completely from trade war discussions, and that will have implications for the market going forward and obviously economic conditions. For 80/20 investors, you've already seen some stuff about the importance of not upsetting your bank manager. That's the talk between China and the dynamic between China and America. So you will understand why the importance of what happens in the US Treasury yield market has, what an importance that has, I should say, on equities going forward. And one other thing that I'm going to pick up with for 80/20 investor members is the oil price. The price of oil has collapsed, and that is likely to have implications for the equity market going forward, which again I will come back to at a later date. But one final thing before we finish, Neil Woodford. Anybody, if you're into investing, you can't have moved for the last couple of days unless you've been in a cave without hearing about Neil Woodford and basically the closure of one of his main funds. And I'm going to pick up that theme on this week's podcast, so make sure you listen out for that on Sunday. It's going to be a show that's going to be covering a lot of lessons from that people need to learn. It's not just about whether you invested in Woodford or not, but other lessons to learn, much more wider lessons relating to the world of finance and DIY investing. So that is it for this week. If you want to get in touch, then you can. Usual ways, Money to the Masses on Twitter with the number 2, Damien at moneytothemasses.com is the email. So until next week.